going on, everybody? It is Tuesday, September 28th. Markets pulled back today. Was pretty ugly day. So we have, number one, a potential government shutdown coming by Friday. We have the debt ceiling still out there, where Janet Yellen today told Congress that the red line in the sand is October 18th. That's the day she's saying, after that date, it's going to be difficult for Treasury to make payments unless the debt ceiling is lifted or suspended. The effort to raise the debt ceiling today in the Senate was blocked 2 times, I believe, by the Senate GOP, so that's not going anywhere. They're talking about maybe now proposing a continuing resolution to keep the government funded without including a debt ceiling increase. McConnell said, he's perfectly willing to come up with something to keep the government open, but the Republicans are not going to agree to a debt ceiling increase. Frankly, I don't understand why the Democrats don't just push this through in their reconciliation bill. I guess there's problems with that. I don't know. But it looks like a mess. Fiscal flows are slowing down. I mean, they're not cratering, but the year-over-year growth rate in spending is now the slowest all fiscal year, but it's still 12.8% above last year. We're about $880 billion over last year. We're going to end up finishing the month of September with about $580 billion, $575 billion. That's a little bit below what I thought. I thought we'd see around a $600 billion number, but it looks like it's going to come in less than that. And if we get a government shutdown, then the fiscal flow slowdown is going to accelerate. So that's going to take some support out of the market. I don't think we're going to crash. I think we can be in one of these choppy correction periods. I want to talk about the $1 trillion coin. Maybe you've heard about that. Now this story goes way back, and I was, really kind of in on it from the very beginning. It goes back to I believe it was maybe 2007, maybe even prior to that. It was on Warren Mosler, who's a very well-known MMT guy, economist, had a blog. Back then he used to allow comments on the blog. And, in one of the discussion threads, one of the commenters, who called himself Beowulf, he's now known as, his real name is Carlos Mucha, he's a lawyer, he cited a statute in the U.S. Code where the Treasury is authorized to mint a pure platinum coin or 0.999 platinum coin in any denomination, okay? And that is the authority granted to the Treasury Secretary. Doesn't have to ask Congress, doesn't have to ask the President. It's in, let me see, Title 31, if I can remember this, if you want to look it up, Title 31, Section 5112K of the U.S. Code, okay, if you Google that, or if you just Google platinum mint the coin, I mean, that's been out there now. So it's totally legal. It's totally within the rules of United States law that the Treasury Secretary at any time could mint a pure platinum coin of any denomination. Okay, it could be $1 trillion, it could be $2 trillion, it could be 50 trillion. I mean, that's the law, and that could be deposited in the account, the Treasury's account at the Fed. That would absolutely circumvent the debt ceiling. Again, this is law. It's authorized. It is doable. I mean, there have been a number of legal scholars, one guy, Rohan Gray, who I know, who have written an extensive kind of evaluation, legal evaluation on this. It's totally within the law that they can do this. But of course, they're not going to do this because it seems gimmicky. It would trigger, massive criticism and critique. And that's not a reason, by the way, that's not a reason not to do something. Okay, that's kind of like a cowardly position. But I said today in a tweet, and I wrote on my blog, sometimes optics override reason and logic because we're all human. I mean, we do things sometimes because we feel it looks better to do a certain thing than to do something that's rational and logical because, maybe we feel embarrassed by it. Maybe we don't have the courage to do that, to take that step or whatever. And basically, that's what this boils down to. Look, I have said many, many times that the debt ceiling ought to have been eliminated. We ought to get rid of it. It's an anachronism. It's a throwback to the days of the gold standard. We're no longer on the gold standard. It's a self-imposed constraint, and you get these ridiculous and dangerous, by the way, situations where, there's a real threat of default here. And there is a way to circumvent this by using the mint the coin. That's a hashtag on Twitter, and it's trending. And it's totally legal. It's totally, written in U.S. law, in the statutes, in the books, but they're not going to do it. Now, I want to point out another thing. If you look at, and I was just looking at this today, if you look at the disparity in euro bond yields against U.S. bond yields, because today we had the 10-year Treasury shooting up to 1.5, 1.55, 1.56%. Okay? That's the highest since June. And if you look at, and remember, United States is a currency issuing country. There is no inability for the United States to meet its obligations in U.S. dollars, unless, of course, the idiot Congress decides to voluntarily default. Okay, remember that point because it's a critical point. Anyway, countries like Greece, countries like Italy, countries like Spain, countries like Portugal, even Germany, France, the Netherlands, okay, have bond, and by the way, all of those countries that I mentioned that are in the euro area, they all gave up their sovereign currency. They are no longer currency issuers. They are currency users. The euro comes from the ECB, the European Central Bank. That is like the de facto, almost really the fiscal authority for the euro area. None of those countries that I mentioned have their own currency. You don't have the drachma anymore. You don't have the lira. You don't have the Deutschmark. You don't have the peseta. All right? So really, in reality, there's infinite more risk to those countries' bonds than there is to U.S. Treasuries. But yet the yield is substantially higher in U.S. Treasuries. For example, the yield in Greece. Remember when everybody used to say, oh, U.S. is going to become a basket case like Greece? Well, guess what? The 10-year yield on Greek bonds is 0.84%. Italy, which is a basket case itself, the 10-year yield is 0.85%. Spain, 0.45%. All right? And it goes on. I mean, the yield in Germany is negative. The yield in the Netherlands is negative. So, there's only one way to really, I mean, there might be two ways, but for me, there's one primary way of explaining this divergence in yields, because it's completely ridiculous. I mean, when you think about it, you have these countries, none of whom are currency issuers. They're all currency users. Some are really, really sketchy economies, all right? Highly dependent on, inflows like Greece and stuff like that. The only way you can explain it is that the United States Congress holds out this threat of default every couple of years. And honestly, I kind of hope this happens, and I'll tell you why. And this goes back to something that happened in 2011 when this idiotic, ridiculous credit rating agency, Standard & Poor's, downgraded U.S. credit. And at the time, and leading up to that, I said, and I predicted that one day they were going to downgrade the credit rating of the United States because they're absolute idiots and they don't understand that there's no inability of the U.S. to pay in dollars. But they did it. And I said, when that happens, you buy bonds. Because everybody up until that point was saying, oh, the interest rate is going to spike through the roof. You know, the Chinese are not going to lend to us. Our creditors are going to demand higher rates. And what happened? As soon as they downgraded the debt of the U.S., interest rates plummeted down. Bonds shot up. And I said, I knew that was going to happen. And I kind of hope we get the same kind of outcome now with the debt ceiling. I hope the government defaults. We may get a very quick temporary spike up in rates. But then the Fed, as it normally does, is going to defend its policy rate. It's going to come in again. It's going to expand QE. The rates are going to drop. And we're going to finally eliminate this threat. Now, unfortunately, the threat is going to be real for people, maybe people receiving Social Security payments and other payments, because the government's probably going to renege on that stuff because they're so afraid not to pay principal and interest to the Chinese, who they still think, the government, these people in charge, still think we borrow from them. So they're gonna prioritize paying China. Maybe you're getting a Social Security check, they're going to take that away from you, but the bonds are going to be fine. And we could finally at least burst this one bubble about solvency and all this other crap. Anyway, it's going to be very interesting. There's going to be a lot of market opportunity here. Not quite sure which way right now, but we'll follow it. Anyway, that's it for today. Go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. Bye.